All right, welcome back to the Eugene Exchange podcast. The market is open. It's been about a week since the last podcast. I think I've chosen now Tuesday is the weekly podcast day. The important thing about starting up anything new is not so much the idea, it's execution. I was talking about this with a friend recently. If you want to start something new, like say, for example, a channel, what you need to do is pick a day every single day or a certain time to always work on that. In reality, it's not about the idea of what you're making, but actually just forming the habit. And everything requires consistently working on it. For example, on this, if I want this podcast to succeed, what I've done is I picked Tuesday. Every week, Tuesday, I'll work on this podcast. I'll do research. I'll read the news. I'll do the pre-work, the pre-production. And after a while, it'll become second nature. Being consistent is how you achieve what you need to achieve. Not so much raw talent, but being consistent and forming habits. I've learned that over the years. Anytime you want to work and get a project off the ground, first things first, just establish the habit. That's all you need, and you can take on anything. As long as the habit's there and you're showing up and putting in the time. In reality, what's important is the habit. And what does the habit mean? It means you're actually going to the designated spot and putting in the time and the work. Habit, time, those two terms are interchangeable. Anyway, back to house cleaning work with the podcast. After the release of the first episode last week, a lot of people, pretty much all of my mutuals, reached out to me, and I really appreciate it. The debut of the new podcast brought out just about all my mutuals out of the woodwork, and it was really great to see everybody again, and especially all the kind messages people wrote to me when they saw that I was undertaking something new. Naturally, I responded to each and every one of you, and I really appreciate it. That being said, it seems like the response to this podcast has all been from people I've had some sort of exchange with in the past. What I mean by that, so these people already know me from my previous work, and I would have liked to see some new faces though, but you can't ask for everything, especially on the release of a brand new podcast on a 300 sub channel. We gained about 8 subscribers just from the last uploads. That's huge from a podcast with no marketing and really no notoriety or existing fan base to speak of, so it really was quite special. I'm very happy with the release of the first podcast. In fact, now that this is a second episode, I think this is now the second time ever on this channel, on the Eugene Chargrain channel, where I've talked about a follow-up to a video I wanted to make, and now I've actually done it. There was one other time when I had a subscriber investing portfolio. It feels great now, and I know that with the second episode, we're moving even closer to establishing that podcast. This podcast will become a weekly thing if I just keep at it. Really great. One thing, though, I did have some issue with was that originally I intended the podcast to be 1 hour. I would like every episode to be 1 hour, but I've learned now that podcasting for 1 hour is quite the skill, and that's a skill I'm going to have to work on. Maybe it involves speaking more slowly and purposefully. Maybe it involves just more content straight up. I'm not sure. I need to work on that. After listening to the podcast, my friend was telling me that I probably speak too directly and I'm too forthright with the information I'm giving. And he's right. I think I'm just too much to the point. I just want to get the information and not dilly-dally around, and that's what you need to do to successfully podcast. You need to drag out the useful information. If it were just me, my style would be I'd have a list of facts, a list of information. I'd go straight through it on every single point and give you what you need to know, and that would be the end of it. But then guess what? You have a 10-minute podcast. And podcasts are quite the different medium. Video, you should be direct to the point as possible and as fast as possible, at least as long as you can maintain people's interests. In a podcast, people have a lot of time they're willing to set aside, and you need to entertain and occupy a lot of time. If it's just 20 minutes, the person who's looking at that podcast will think, oh man, I have to find new content again in 20 minutes. I gotta search for my next hit of content and dopamine in just 22 minutes? I can't do this. So this one, I'm going to try to aim at least for 30 minutes, fingers crossed. If not, I'll keep at it and I'll keep working on the skill. In the meantime, I had a few writers. I contracted a few writers to work on intros for the show and the podcast. And the purpose of these intros were to establish credibility. Even still, despite my pedigree on YouTube and investing, almost nobody knows who I am. So the intro would have given a quick synopsis of who I am and what I've done, and listeners would immediately know what I'm all about. But I think I was going at it the wrong way now that I actually read the intros the writers wrote for me. My goal was to, again, establish my credibility as an investor in talking about all these topics, but at the end of the day, I don't think people really care about that as long as you're not delivering the content. So I've decided just going to put myself out of it and only give the information, the facts, and then after time, enough people will see that I'm right over and over like I have been in the past. And then from there, credibility will grow. When you're in the growth phase of a podcast, I don't think you should be saying, look at me, I'm so credible, I'm so good at what I do, when nobody's looking. And I had a problem with this in the past too. I made some really great predictions, ones that just totally shot my credibility up to the stratosphere with everybody in my immediate circle of friends and circle of acquaintances. But what I was doing was I was demonstrating my abilities and competencies to too small of a group of people behind walls that the general public could not access. And what do I mean by that? So, in private messages or on the chatting apps, I was saying, oh, do this, I'm going to do this, I'm going to do that. And yeah, everybody I was talking to, clearly, I demonstrated that I know what I'm talking about. But those people are people I already talked to, and it wasn't bringing any new people. So anytime you're trying to put content out there, the less walls and the less barriers of access to that content, the better. And I've learned that now. And so now for the podcast, I'm going to put my thoughts as transparently and as publicly as possible. So that's the solution to the intro problem. So what I'm going to do is from now on, the podcast is just going to have a short intro song. We're going to get right into it. And maybe I'll revisit the intro in the future. I definitely would like an intro, but now's not the time for it. Tangentially related to that topic, a pretty well-known YouTuber reached out to me actually 2 days ago and asked me if I did any investing. We met in February of this year, and naturally I was telling him, number one, coronavirus is coming, and number two, he should get into investing, but wait for any precipitous drop in the stocks. And he just messaged me now 2 days ago and said that he should have listened to me when I was telling him about the opportunities back in that time of year. Now, naturally, my reply to him was that no worries, he's been investing now for some time, and that there have been plenty of opportunities that I've seen him cash in on. So that's yet another feather in the cap of people reaching out to me and saying, oh yeah, you were right, I should listen to you. What's your next move? I'm really curious. And in fact, this YouTuber did ask me as well, are you doing any investing? What are you looking at right now? I take that as proof positive that I've got the stuff and the content will be delivered on the podcast. All right, now for the news. As I record this, Bitcoin is back at the magical number 19K. And for those of you who remember, the last peak of the Bitcoin price was now a little over 2 years ago in the final months of 2017, early 2018, when it hit that magic number 19K, $19,000 per Bitcoin. With the rise in price now pushing all-time highs, I saw the price touch $20,000 the other day, but now it's naturally back to $19,000, the true price of Bitcoin where it belongs. Naturally, though, it's back in the news. Everyone's talking about it. Everybody's coming out of the woodwork and even messaging my friends. Oh, did I tell you about Bitcoin? I should have told you about Bitcoin. This thing's going to the moon. Bitcoin's the future. It's time to break down the news on Bitcoin now that it's been forced back in everyone's consciousness. As some background, I've been through now 3 of these price cycles of Bitcoin. So I first got into Bitcoin in 2012 when at the time it was spiking to $1,000 and I did what people are doing now, which is buy at all-time highs. Anyway, so the price was spiking to $1,000 and I was sold on the idea of Bitcoin, and so I rushed into it and I took literally every penny that I had, just about, and bought in at Bitcoin at $1,000. Back then, as it has many times since then, the price fell, I think, from $1,000 to $200. I was determined to hold, though, because what else could I do? I could have sold and locked in my losses, but I still believed in the product. I still believed in the system and service that Bitcoin provided. So I held and held, but because I made a mistake and I was very young and foolish, I put every single spare penny I could into Bitcoin. I literally wasn't able to buy food at some point. So what I had to do was I broke up my Bitcoin wallet, found a service that exchanged Bitcoin for gift cards. So I picked a gift card from a pizza joint and got gift cards, and I bought pizza every week with my Bitcoin until just about all of it was gone. I bought pizza with Bitcoin and the process got fatter because of it. And I was spending Bitcoin that had lost 80% of its value. And actually, when Bitcoin spiked up again after that, I had nothing to show for it. So I learned from that. I definitely learned from that experience. And there's obviously a parallel now between what happened in 2012 and now. This is now my 3rd Bitcoin price cycle. And what I mean by that is this happens every single time. Just be patient and calm down. Here's how the cycle works. Bitcoin spikes to an all-time high. Some people buy in at that all-time high and it goes a little higher and they make a bunch of money. But then afterwards, there's always a massive pullback. That happened in 2012, 2018, and now, once again, in 2020. I have to ask the people who are interested in Bitcoin right now, where were you when the price was $5K, $5,000 a year or two ago? Where were you? That was the buying opportunity. Don't buy high and sell low. Now, the reason for this move in the price of Bitcoin is quite simple. It's PayPal. You'll be seeing Bitcoin on PayPal checkout screens, presumably sometime in the future. And so as a result, I think the price movement in Bitcoin is in fact completely warranted. Given now that there's been a major barrier to Bitcoin adoption, it's been removed. It's now much easier for people to be exposed to Bitcoin and to use Bitcoin. But from an investment perspective, I buy Bitcoin when all the teenagers and sudden Bitcoin geniuses and experts come out of the woodwork. I buy it when the interest is not there. I buy Bitcoin when people are getting upset and closing down their Bitcoin channels and Bitcoin server farms. What you need to do is go back onto YouTube, and there are a ton of Bitcoin channels that are graveyards now. They just sold the shop. They quit in 2018 because they couldn't hack it anymore, and the commenters are angry at them for all abandoning them. Just remember that the Bitcoin community, particularly online, is on the cutthroat side, and as soon as things don't go well and as soon as real money's on the line and people lose, they head for the hills. They cut their losses and then leave people holding the bag. It's quite unfortunate. I do in fact own Bitcoin, and I think Bitcoin has a role in any investment portfolio, and even the biggest experts and the most mainstream firms and organizations will mirror what I'm saying. Bitcoin's role is like gold. It's not really meant to be cash in your wallet. So I hold Bitcoin along with currencies from countries that have successfully dealt with the coronavirus, and it's part of a hedge strategy. Naturally, everybody's so interested in dealing with inflation and the collapsing price and value of the US dollar, and that's a perfectly reasonable concern. I've been watching the US dollar versus many major currencies, particularly, again, the US dollar versus countries that have done well dealing with coronavirus. I've taken a look at those prices, and the US dollar has been falling in value for a year straight. Bitcoin's role in this is half the role of gold and half the role of Forex, or an alternative currency. It is an hedge against inflation. That is the role of Bitcoin. When people are losing faith in the dollar or the system in the US, they turn to Bitcoin. It's got dispersed adoption throughout the whole world, and it has a role. Bitcoin is not illegitimate. I don't think anyone's really saying it at this point. I'm getting flashbacks from 2012 when people used to argue all day, every day that Bitcoin is illegitimate. In fact, the subreddit for people who thought Bitcoin was going nowhere was called Buttcoin. That's what it was called back in the day. The funny thing is, if people had bought Bitcoin in those days, oh man, they would have made a ton of money. You would have 20x'd by now. Really incredible. But anyway, don't follow the buy high, sell low herd mentality. I know it's no coincidence that the Bitcoin price has spiked up and everybody's talking about it now. And that has nothing to do with Bitcoin or any of its properties. No one has an interest in that. They just saw that, oh, Bitcoin line went high and there's more money to be made. If you're in Bitcoin, if you're into Bitcoin, if you have an interest in Bitcoin, if you're thinking about it now that the price has spiked up, you need to be prepared to hold Bitcoin when, let's say, the price goes down 40% from the high. Are you ready to hold for 3 years at a price loss, waiting for it to spike up again? I know of a lot of people who were buying Bitcoin at $19,000 now back in 2017, 2018, and they would have been holding until now, and they would have just now broken even. Are you prepared to do that? I could see someone buying some Bitcoin now at the price it is right now, $19,000, and if you're prepared to hold it for 3 years, that's perfectly fine. But here's what really happens though. People get greedy and they see the price action and they put every single penny they have. And that is not a situation you want to be in. You don't want to be where you're staking everything you have because you don't have a lot of money, you can't spread your investments out far, and you put everything on Bitcoin, and then you're put in the situation where for 3 years you need to ask yourself every single day, oh man, all my money's in Bitcoin, it's down 40% or whatever. Should I sell? Should I just get out of it? I need the money. I wasn't prepared to hold this long. Don't let that be you. That's how you lose in Bitcoin. How you win in Bitcoin is, sure, I could definitely see the price of Bitcoin going up from here. Totally. The longer you wait and the higher you buy, the more chance it's going to be it pulls back like it has now 2 times now before. The 3rd time now, it might just pull back again. If it's some of your money, if you only put in a small percentage of your investable money, then you won't be put in the rough situation where you have everything in Bitcoin and you need to think about selling at a loss when the price pulls back. So what I'm saying is that if you do want to get into Bitcoin now, which again, I could see it going up further from here, don't put everything you have in it. Be prepared to hold for a long time at a loss. And that's what I've been doing. Not holding at a loss, but I got into Bitcoin a couple years ago when it wasn't doing so well and people were closing down their channels and getting upset and quitting the Bitcoin industry. And look where it is now. That's all I'm saying. You need to be able to look at the macro picture. All these people talking about Bitcoin till the sun came home, till the sunset in the evening. Where were they a few years ago when this wasn't hyped, when this wasn't interesting to people? Be careful with Bitcoin, listeners to the Eugene Exchange podcast. Just be careful. Next up, we have a post from the investing subreddit about a very interesting experiment with investing. Essentially, this is about passive versus active investing, and the person who wrote the post is comparing how well they did over 2 years with two portfolios. One that was blindly buying S&P 500 ETFs, and one that they were actively trading and investing in. And the results and also the response of other people I think will interest you very much, and I think this is important news to bring to the listeners of the podcast. So I'll read the post and then give my commentary on what this person wrote afterwards. So the post reads as follows. Passive versus active investing, 2-year experiment. In December 2018, I sold a business for mid-7 figures. So that means that they sold the business for about $5 million. Being burnt out after 15 years, I did not intend to jump straight back into industry, so decided instead to test an active versus passive investing strategy for a few years. I was a die-hard, efficient market/bogglehead, but always enjoyed the process of stock picking and being a hubristic censored, and decided to put half of my money on the S&P 500 and half of my money into a separate stock-picking retail account portfolio. My background is in private equity, and I'm comfortable doing deep dive research, building DCF models, etc. Half of my money went to the S&P 500 on the 2nd of December 2018 at 263. I've done nothing with this account since. Dividends, of course, were auto reinvested. In the active account, I built a portfolio of small and micro-cap stocks. The portfolio held 14 stocks after 21 months. Few have been turned over since, with new ones added, but generally the approach has been to buy and hold good businesses. Dividends were also auto reinvested. I spent 15 hours a week on research and analysis, so in total about 1,380 hours since December of 2018. Now here come the results, which is the interesting part. He writes, since the 3rd of December 2018, the S&P 500 with dividends reinvested has returned 21.5% annualized. The active portfolio has returned 25% annualized, so that's obviously more than the 21.5% that he got in the S&P 500. He then continues, incidentally with a higher Sharpe ratio / lower max drawdown. It is delivered, meaning the actively invested portfolio, in raw terms, an additional $90,000 over the passive fund. If you divide that by 1,380 hours, that equals $65 per hour. Is it worth it? Sure. If you enjoy something and can do it ad hoc from your own home, being paid $65 per hour is a pretty good result, especially as that figure will compound over time, assuming continued results. I can share the portfolio and results on request. So naturally, some commenters were quite excited that this person beat the market with active investing over 2 years, and it was proof that these mindless ETF drones that other people like to point to are wrong, and that if you put effort and time, you can in fact beat the market. Whereas other people were quick to point out that this person invested mostly in smaller caps, smaller companies, and research has shown that obviously the large cap stocks are efficiently traded, whereas maybe the small caps aren't, and that's where he got his opportunity, and naturally there was more risk going into his portfolio, and that's how he got the greater return. There were people saying that he should have compared his performance to the Russell Index, which the Russell Index is a index of smaller cap stocks, though more commenters pointed out that that would be more of a fair comparison than versus the S&P 500. The Russell Index actually returned less than the S&P 500, so that multiplies. That makes his gains versus the other index look even better in comparison. Where I stand on this is that, yes, this person in a data set of 1 did in fact beat the market, actively trading, did in fact beat an ETF. And that seems to run contrary to all the mainstream advice from all the safe harbor, play it safe investing channels. But we need to keep some things in mind. Number 1, this person has a background in private equity. they probably have greater knowledge and greater discipline, at the very least, compared to the average person. Number two, this person had a significant portfolio. So as a result, they weren't subject to certain pressures and forces that an average retail investor might be forced to contend with. An average retail investor can't be in many different stocks. If they don't have enough of a portfolio built up, they have to be choosy about which ones they invest in. Otherwise, they'd be spreading themselves too thin. Some people just can't afford more than a few stocks. And this person obviously didn't have that problem. This person also, probably just based on how much money they sold their company for and what they were clearing, they probably didn't have to worry about their day-to-day expenses. And so when you're in that situation, I can tell you, it gives you a level of clarity and detachedness from your investing that is a huge advantage that just isn't available to the average person. Now, putting all that aside though, and ignoring the sample size of this data, it does go to show that, at least in the private equity perspective, if you pick your investments, you can do better than just the broad market average. If the S&P 500 ETF was the be-all, end-all of investing, it was impossible to beat that. You never can beat the market. There's no role of private equity in the first place, right? Investing is about efficiently allocating capital to industries, to startups, to ventures that will return a profit. That is the role of private equity, and to a lesser extent, that is the role when you pick stocks. Let this serve as a data point when you're considering going just straight ETF investing or trying to chart your own path and investing yourself and making your own picks. Briefly, a second post that caught my attention was a Reddit post asking people what they thought their stock pick of the next 5 years were, and I'll go through this list very quickly. Overwhelmingly, the most answers were for Microsoft, Amazon, and Apple, which I would say at the very minimum are safe bets. We're talking the bluest of the blue chips, mega cap corporations. And I think it's safe to say that all three of these will in fact be around in 5 years. So I understand why people pick those. Now, there are a few other ones too. I noticed that some people naturally were saying Tesla, like always. Tesla is a completely separate topic. But there's one person, and I'm so proud of this one person, they said their number one pick in the next 5 years was Roblox. And I can tell you, I'm still excited for that IPO. Reading that post, I was expecting more people to chime in with some micro-cap mining venture or some flavor of the week meme stock that in fact probably won't be in people's radars in 5 years, but I was actually quite impressed with this post. Most people were picking safe, blue chip, mega cap stocks, and maybe it goes to show that people's attitudes are finally moving away from meme stocks to something more sensible, more stable, and more sane. Never know, could be. Someone can dream. Next up, we have the Martin Minute. Since the last Eugene Exchange podcast, there have been no updates on the Martin Shkreli blog, unfortunately. However, as I promised last week, Martin Shkreli has talked about a few stocks he's interested in, and I've taken a cursory look at these stocks, and now I can come back to you and report on what I've found. Before I get to those stocks, though, I will say there's no time for it on today's podcast, but Martin wrote a really excellent essay on Treasury inflation-protected securities. Again, it's really worth a read. You should check that out. Moving on to, I think everyone's been waiting for this, the Martin Shkreli praised, talked about stocks that pique his interests. I have them all compiled here, and I will present them to you now. First on the list, one he was talking about was CTIC, which is CTI Biopharma, currently trading at $3.60. He said that this one will probably keep going up, and that its fair value is $6. Almost doubling. I'm keeping an eye on this one. He took note of the KDNY IPO, which is now public. No commentary available on that stock other than the fact that he noticed it crossed his radar, and it is now public. KDNY naturally is a biotech company that focuses on kidney diseases. Next on the list that unfortunately, I was just too late. I wasn't able to bring this to you, but actually proves just how much of a genius Martin is, was MRTX. When Martin first blogged about this stock, it was around $180. Now it's at $237. It was a massive move up. Now, let's talk about what he said, despite the fact that it's now too late. Mirati MRTX, this is Martin, may have what will be one of the biggest cancer drugs ever. We will know in a week. And then fast forward a week later, it in fact did move up, and he wrote, MRTX, quite the move. So too late now for you guys, but hey, that was the home run. He got that one right. Next up on the list is KOD, Kodiak Sciences, KOD. He writes, KOD has worked for me. I think it keeps going. At the same time, I'm just starting to look at Gray, Gray. KOD Kodiak has been a big winner, and I think it has to remind everyone that wet AMD is really one of the biggest indications ever. You literally have millions of people facing the most unproductive event possible, blindness. One has to wake up and smell the vectorized antibodies as the potential solution. No matter how much goop you shove in the eye, you'd rather not do it over and over, and again, you'll have to. Having said that, I'm sure it's not too easy to AAV your way out of this, meaning adeno-associated viruses. ADVM, another stock, etc. are probably worth the moonshot. That's Martin. So basically what that's talking about is that conventional treatments to wet AMD or these blindness events usually involves these really nasty treatments, as he's describing it, shoving goop in your eye over and over, and he seems to think that Kodiak and possibly Gray and ADVM have the right approaches to this, and he's right that on a macro level this will be a huge benefit to society when this problem is finally tackled by a new therapy, and naturally you'll see stock prices that will reflect that. Moving forward, he says Gilead Sciences, GILD, looks cheap, though I will note when I was watching his live streams now back in 2015, he said the same thing. He actually dedicated an entire live stream when he started his This Week in Investing series, that he did an entire episode talking about how Gilead was cheap. It was a cheap stock and the price models lined up on it. And I will say Gilead Sciences has done well over the past few years, but just keep in mind this is a recurring thought process that Martin has. At the same time too, it's got a nice dividend, can't complain. Once again, moving forward, he says KRYS is cheap, I think. It's literally the quote, he thinks it's cheap. CRISPR is a huge short, and that MRSN looks quite interesting to him. So that's just a ticker drop of all the various tickers. I'm still doing my investigation, my own research into these, and when I develop my own thoughts on this now massive list of stocks, I'll tell you about what I think about each one, but for me this is still very preliminary. I spend a long time looking at a stock, particularly if it's a pre-commercial biotech. I'm very careful about which one I pick. That said, in my experience, Martin has over 70% win rate on his longs. So for me, even if I were just to buy every single one of these blindly, I think I would do well, though I like to take it a step further than that naturally. Now to wrap up the podcast, the final news item is YouTube and what's going on in the YouTube world for those of us who derive our income off of YouTube. As always, this is the month of December. And in the month of December, as we all know, CPMs are quite high. That AdSense revenue flows in like milk and honey. If you have a YouTube channel right now, start pumping out videos. Upload much as you can. Upload. It's printing money. This is what YouTubers live for. I don't know what you're doing. If you're a YouTuber and listening to me, why aren't you working on a video? You should be making content, not consuming it. That's what I'm doing. I'm sitting in front of a microphone churning out videos trying to get my channel monetized. Speaking of which, if you're listening to this, subscribe to the Eugene Chargrain channel. We need to get to 1,000 subscribers and get our watch hours up so this thing can get monetized. Naturally, if I'm motivated to make videos because I'm not doing it for free, more content for you, more investing content, more good quality investing content. I won't just tell you Tesla over and over. I'll tell you how it really is. And the more I do this, the better I'm going to get at it. That's all for this week. Thank you for listening. Don't forget to check out the Telegram Investing Journal. That's where I write my thoughts and the latest blog posts about the world of investing and how to make you more money. Thank you to everyone who commented on the last video, and I will see you next week.